Good afternoon. This is Tom Alexander. It is Sunday, July 23rd, and it is about not quite 1 p.m. in beautiful Charleston, South Carolina. This is the video addendum to the weekly report that I send out each week that you can find posted on the website under weekly updates at www.alexandertrading.com. If you are not receiving this report, a free report, and the free reports that I send out in addition to this one, shoot me an email to tom@alexandertrading.com and I'll be happy to put you on the list. Also, if you find value in this video, please like it, please subscribe to the channel. All of those things are appreciated and help me grow the channel. Okay, let's start. Let me share the screen because sometimes I will forget. Okay, I'm going to start with the weekly charts, but just a little bit of commentary first. The indices have been in an extraordinarily initiative trending mode, the NDX, the SPX, and the Dow. The Russell has joined the party. I talked for months about the Russell not having joined the party, and that was a necessary component if we were going to be in another multi-year bull market, or certainly a bull market that exceeds 2 or 3 months, which would still be a bear market, et cetera, et cetera. But regardless of how you want to label stock indices right now, until last week, we've been in an undeniable strong bid accumulation phase across the board, very consistent. NDX, SPX, Dow, and Russell. That's very positive behavior. Now, 1 week does not a top necessarily make. Now, we can see inverted V tops, but it's unusual. Even if we go lower next week, at this point, you're still looking for last week's highs to be taken out eventually by one or more of the primary indices, even if a top is forming. So we are on my screen here. You can see the NDX. This is a weekly chart. We're less than 5.5% from a new all-time high. In the SPX, we're about 5.3% from an all-time high. The Russell, we're a long way from an all-time high. Now, the Russell has been, it's been the thorn in the side of the bull case since the October low, frankly. Actually, there's the double bottom in the Russell. It was last June and then last October, or June a year ago, and then last October. And now, once again, the Russell is approaching an upper key reference area that's absolutely critical. Now, over the past 2 or 3 weeks, it has certainly played catch up with the rest of the market, but there's still work to do in the Russell to confirm, in my mind, that we're in this new, wonderful, ripping bull market powered by AI. Okay, let's look at the Dow. And the Dow is very close to its all-time high. And I think this is lost on a lot of people. The Dow was actually only about 4.5% away. The Dow had this extraordinarily vertical move, and then the rest of the market spent like 6 months catching up to the Dow as the Dow went net nowhere. But the Dow is caught up in spades. Last week, if you look at the weekend report, the weekend update from last week, I highlighted this as a mature balance area. And in auction market concepts, when you have a mature structure like this, the inevitable is a break out of that structure. We certainly had it in spades. Now this level will become an important downside level. So let's look at the levels. Let's look at the cash charts. All right, so here is the Dow. And this is the level to keep an eye on down here in the Dow. These levels are all posted in the weekly update. So I'm not going to spend a whole lot of time just reading these levels. You can see them for yourself. Actually, you can also print out the PDF. There's a PDF that I've linked to in the weekend update that if you choose to print it out, you can print it out and it will have these levels on here. So we came in last week in somewhat rather dramatic fashion. Now, the big overhang next week, we had option expiration on Friday, which was a very big option expiration. That could have some carryover into Monday, who knows? But certainly the Fed meeting Tuesday and Wednesday is going to be the thing the market hangs on to as we head into the week, into Wednesday. Trying to guess the next 3% move in the market ahead of that meeting is it can't be done with any accuracy. You just have to laugh at anyone that is telling you the next 3% move ahead of that Wednesday Fed announcement. So that's where we are with that. Now, looking at the internals, what you see here, the red line is a 10-day moving average of NYSE advancing issues. The green is a 5-day moving average of advancing issues. The blue is closing NYSE breadth, advancing minus declining issues. There are divergences, but we've had divergences after divergences after divergences since this March low. But we have not exceeded the momentum high so far that was established following the March low at the end of March, which is interesting. And one would think that that is rapidly coming to a head here. It's not, I caution you about assuming just because there's another divergence here that this is going to be a substantial decline. It could be, it's too early to tell. There's certainly gaps below here that we'll be keeping an eye on in real time that hopefully will guide us. And then the last thing I'll leave you with is this is something that we use very actively in our day-to-day work in the membership and in the live trade room is the 30-minute S&P cash chart juxtaposed against breadth. And we have been in a price breadth bullish trend. If we see selling on Monday and Tuesday, it will flip this particular perspective from bullish to bearish, and that has numerous implications I'll be covering in full time. I hope you guys have found value in this. Enjoy the rest of your weekend.